Hello, everybody. My name is Peter Mitchell, Managing Partner at Kingsgate Capital Partners. Welcome to Five by the Fire. These short, sharp podcasts are designed to provide allocators and influencers of capital a deeper understanding of the managers we represent, as well as their strategies. In this episode, we have Gary Segal, Head of Commercial and Operations, as well as General Counsel for Oceana Funds, one of our investment management partners for the last 3 years. Gary, hello, and welcome to what is your first appearance on Five by the Fire podcast. Thanks for making the time to share your insights with us. We're really looking forward to it. Also joining me is Shaun O'Malley. Shaun is one of the special advisors that we have with Kingsgate Capital Partners. Shaun has 25 years of investment management experience working within Australia, ranging from being on the research side to also being general manager of public and private markets at various institutions. So, Shaun, thank you very much for joining us. Now, why don't I just hand it over to you? Take it from here.
Thanks, Peter, and thanks, Gary, for joining us today. It's probably easier, first of all, Gary, for you to explain to us who is Oceana and how long have you been running the Oceana Australian Fixed Income Trust?
Sure. Thanks, Shaun, and thanks, Peter, for having me today. It's great to be on. So Oceana has been going for 10 years. Our flagship strategy is the Oceana Australian Fixed Income Trust, which is an alternate private credit strategy with fixed income characteristics, meaning essentially that we pay fixed interest, and the products are effectively issued for a 5-year period. We started in 2016 with a focus on trade and invoice finance, and have built a $1.6 billion fund focusing on various credit products across the SME and MME markets, still with a primary focus on trade and invoice finance as well as secured corporate lending.
Thanks for that, Gary. And you've probably touched on this question already, but as investors look to be reallocating away from, I suppose, the first wave of real estate-backed private credit towards the second wave of more alternative private credit, what do you think are the unique characteristics that position your strategy differently to others in the market?
Yeah, sure. Look, the first and most obvious answer is the asset class itself. So we're not a real estate focused fund. The real estate private credit funds, which make up the majority of the market in Australia, have a single asset or, a small number of assets with quite a bit of concentration risk. So our asset class, which is, as I mentioned, focused on trade and invoice finance, offers investors significant diversification, not just across the borrowers, of which we have 9,000 approximately in the book, but also across product types, given that we focus on trade and invoice finance, as well as secured corporate lending, as well as SME micro cash lending, as well as maintaining a portion in cash for liquidity purposes. The other key point is diversification across sectors. So we spread across about 10 different sectors in the Australian market, with a focus on defensive sectors such as agriculture, pharmaceutical, logistics, government-backed NDIS funding, wholesale trade. So it's the key aspect would be diversification across a number of different factors.
Thanks for that, Gary. You started to explain this for us, but can you give us a little bit more on the makeup of the loan book and how many industries you really do focus on? It's obviously not just real estate.
No, yeah, and just to clarify, there's no real estate in our book, so we don't focus on single asset real estate strategies or construction, for example. We're spread across about 10 core industries, including agriculture, forestry and fishing as one of our primary sectors, rental hiring, real estate services, healthcare and social assistance, transport and logistics, financial services, manufacturing, wholesale trade. So it really is focused on sectors in the Australian economy that really do service SMEs and MMEs with essential goods and services primarily. Real estate is not a core focus of our fund, which is one of our key differentiators.
Yeah, so if I've got that right, so you've got about 14 industries that you focus on. And so how many loans are in the book currently?
So it's diversified with approximately 9,000 loans across across all states in Australia. The average loan size is about 120,000, average tenor of about 90 days. So as I mentioned, the book is spread across about 14 defensive industries, with that focus on agriculture and pharmaceuticals still being a primary, core aspect of the book.
Thanks again, Gary. What is the liquidity of the strategy, and what are the current rates that investors are able to lock in the form of a 5-year note currently?
Yeah, sure. So the typical note structure that we offer investors in the high net worth or family office, multifamily office space is typically a 5-year note with fixed interest. We pay 8% fixed for A notes, 9.5% for B notes, and 11% for C notes. And with that, that's not a lock-in period. That we offer 60-day liquidity, but you can kind of leave the investment in there for 5 years, and you're guaranteed, or we confirm that investment is fixed for that period at those rates.
Okay, so obviously the shorter duration of the loans within the book obviously allow you to provide a little bit more liquidity than others are providing in the market.
Yeah, absolutely. So that loan book across 9,000 borrowers with an average loan size of about 120,000. The range of tenors does start from as low as 30 and does build up to a maximum of about 12 months across the loan book. It is sub 120 days or sub 90 days, which does allow us to offer investors that additional flexibility by way of a 60-day notice period to redeem.
Thank you. And being a very different strategy to some of the others in the market, what is the typical makeup of the limited partners or the investment base that you've got here domestically at the moment?
Yeah, we've been very fortunate to generate a lot of institutional interest, particularly out of the US. So about 83% of our book is classified as institutional LPs. About just under 14% is high net worth and family offices. The primary geography of our capital table is actually US. So we have very strong asset managers, endowments, insurance companies, basically supporting us since close to inception, which has really helped, catalyst for the growth over the last 3 to 4 years, where we've grown at about 200 to 300 million per annum.
Well, that's pretty impressive. Just before we finish off, I've got one more question. I just wanted to sort of get a bit more of an idea of the credit support that might sit within the book that also supports the yield.
Yeah, absolutely. So a key differentiation of our fund compared to typical funds in Australia is that we're not a unit trust. So you're not purchasing an equity interest. You're actually investing in a loan note issued by Bank of New York, Australia. So in that loan note, we fix the interest for 5 years, as I mentioned, but it's a debt instrument. So your investment is locked in at par, and we are obliged to pay you that interest, and we're obliged to redeem on the maturity date. The different rates that I mentioned before, really the only difference between that is the seniority of the notes, and the first loss protection, which sits below each asset class. And that really is a differentiator in the risk weighting of each note class. So for example, across the book, if you're an A note holder, you've got approximately 450 million of subordinated capital sitting below you as a first loss protection, about 100 million as a B note holder, and about 30 million as a C note holder, which also comprises of the equity tranche that is held by the owners of Oceana, as well as the first loss reserve, which we're required to maintain at all times.
So you've got skin in the game with the rest of the investors. No, that's very good to hear.
Absolutely. And sorry, just one other key point, which does set us apart from other debt funds, is the fact that we focus on trade and invoice finance allows us to effectively credit wrap that portion of the book. So about 70% of the book is trade and invoice finance. That is all insured under trade credit insurance policies with QB and Allianz. That covers borrower and debtor defaults and insolvencies, and is something that we've maintained since inception, and we're required to maintain under our constituent documents.
No, thanks for that, Gary. And look, thank you very much for your time and some of the insights that you've just provided. I think that what you have shown there is that there is a real differentiator from Oceana across the domestic market. And for our listeners, if you'd like to find out more about Oceana, please get in contact with Kingsgate Capital Partners, with the Kingsgate Capital Partners team, or head to the website. Thank you for listening to 5 by the Fire.
Thanks, Shaun. I appreciate that. And thanks, Gary. And just before we sign off, everybody, I just want to say thanks, Gary, for those great insights into what we as an organization found super impressive about Oceana Funds is it provides our clients with a single entry point to the Australian ABS market, essentially. It's uncorrelated to the equity and fixed income markets. It's a shorter duration than any other fund that we recognize at an institutional level. It provides 60-day liquidity to what is traditionally an illiquid asset class. It distributes monthly and is invested in by some of the world's most sophisticated credit funds and institutions, as Gary alluded to, certainly given the high quantum of money that's coming out of the U.S. So thanks a lot again, Gary. Thank you very much, Shaun, for working with us on 5 by the Fire. And again, I'll just reiterate from Shaun's comment, if you have any questions, just reach out to your Kingsgate Capital Partners rep. Happy to help. Thanks, Gary. Thanks, Shaun.
Thank you.